Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action. Just 1 hour left to go in the trading day, and we are seeing a bit of a split picture here with the Dow down about 124 points, the S&P 500 up 10, and the Nasdaq up 107. Tech really leading some of the gains that we're seeing in the market today, with names like Amazon and Alphabet moving to the upside. In the opposite direction, when we're looking at sectors right now, we are seeing energy names down today, largely on oil. WTI down now more than 1.5%, and you see energy down about 1% as well. Looking at Treasury yields right now, we have seen that pull back on the back of the inflation report. We're going to break down those numbers in just a bit, but take a look at where the 10-year yield is trading right now, down about 8 basis points. Now, we saw those moves on the back of inflation data this morning. Consumer prices in April coming in better than feared, as April's headline figure grew at 4.9% on an annual basis. That is the smallest 12-month rise since April of 2021, and the first reading below 5%, I should say, in 2 years. For more on the latest market action, let's welcome in Seth Wonder, Acorn's Chief Investment Officer. Seth, good to talk to you today. We saw the data this morning. You would think that's positive news, at least in the expectation of inflation at least moderating here. What do you make of the market reaction?
Yeah, well, thanks for having me. I mean, I think if you look at this morning's data, it's actually just one piece in a narrative that we've seen for quite some time now. And if you look at the underlying components of CPI, except for shelter, we've been in a decelerating mode for many months. In fact, ex-shelter CPI is only at 2%. And the shelter component this morning we saw was the first downtick since February of 2021. So it's been over 2 years of upward moves in the shelter component. And to see that roll over now, I think is quite encouraging. The market's normalizing to it, which is healthy. You see rates down, you see the market and particularly growth sectors like tech outperforming. But I think this is the beginning of a real sustainable trend now in the change of narrative. And so, you know, we'll see how it plays out from here. But I think these are good components to inflation for sure.
Seth, I got to ask you, so we did have some recent jobs data that came in better than expected. We have this latest inflation print today. What is your expectation from the Fed? Before this data came in, there was an expectation that there may be a pause coming up at the June meeting. What are you seeing now?
Well, so the Fed has two mandates, right? They have full employment and they also have price stability. You know, they're not solely determined on breaking the labor market if inflation finds itself into a better footing, which is where we seem to be heading, and we have been heading for quite some time. And so the reality is like the Fed funds rate is now above the inflationary rate, which is restrictive by definition. And to the degree that the shelter component continues to decelerate, which it should, because it's the math of it is an amortized amount over a longer period of time. The need for the Fed to keep raising rates starts to diminish. And in fact, staying too restrictive as we see some economic slowdown may not be the place to be either. And so the market's really starting to discount Fed rates going the other way, I think, at some point in the back half of the year. So I'm not so focused on the fact that the jobs market is so strong that it means the Fed has to keep raising. It's really that inflation component that the Fed should be focused on. And if we can sustain a level of job strength, which we should be able to for some time, and we see the participation rate incline, which it has been, there could be a bit more slack in the system than maybe people are discounting.
So the expectation of a pivot largely diminished here, but we are expecting here those rates to stay higher for longer. How do you invest in that kind of environment? You look at something like today, I mean, we've seen some of these tech names come back to the forefront. Is that a place that you're a little more overweight on?
Yeah, so think about it this way. So if the Fed were to pause and or eventually get themselves into an easing mode, let's say, we're still going to be dealing with rates at a quote unquote much more normal level. And I think what the average investor has to appreciate is that we really had about 14 years from the global financial crisis until last year of abnormal rate environments that were zero. A 3, 4, 5% rate environment is healthy, right? Like we want a cost of capital. It limits the amount of excess. It creates interest income for people who have diversified portfolios and think about whether it be the 60-40 portfolio or just diversification in general. And it really creates decision-making around asset classes to be a thoughtful conversation. Those are all good things in the environment that we've invested in for decades. And within that, you'll have different phases of opportunities on a subsector basis. So initially, you'll see the rate-sensitive stocks do quite well, so the growth stocks and tech stocks in general. But then we would likely see after that a more broadening of the market, which would be healthy considering that we've seen a fairly narrow market up to this point. So, I would imagine tech and growth would be the first phase of relief. And then from there, you would see other sectors soon follow.
So Seth, you're talking about the current environment, but let's say the environment changes and there is the R word, a recession. What is your advice about how investors should position their portfolio in a recessionary environment?
Yeah, okay, so I'm glad you asked that. So one, recessions are normal, and we should always remember that in the context of being scared about certain words like recession and so forth. Second of all, the global financial crisis being the last major recession, if you exclude COVID for a second, that was an abnormal once in 100-year historical period, and that is not the reflex that everyone should have about every time they hear the word recession. There was plenty of mild recessions. And in fact, the stat that often needs to be repeated for people is that there's been 15 recessions in the last 100 years. 7 of them have seen the stock market go up. And so by default, recession does not mean broad-based market weakness, even though it probably will mean a bit more volatility. Within that, the strategy really is being consistent with one's investments. I mean, if you are dollar cost averaging or being consistent for the long term, and there's market volatility, you get to buy more of the market at lower prices. And so if half the outcomes are positive, and it's a normal process that we think about how we invest over the long term anyway, being able to take advantage of either dips or sustained downturns for some window of time is really quite a healthy way to think about investing.
All right, Seth Wonder, tried and true principle there, dollar cost averaging. I like that one. Thank you so much for joining us today. All right, meantime, shares of Carl Icahn's company is sinking on news that it's facing a federal investigation after a short seller alleged Icahn inflated the value of his assets. Josh Schaefer is here now with more details. Josh, let's get right into this.
Yeah, Diane, so that stock is tanking today. As you noted, that is Icahn Enterprises stock. That is the stock of Carl Icahn. Him and his affiliates own about 84% of that stock. So what happened here was on May 2nd, Hindenburg Research came out with a short report on Icahn, accusing them of Ponzi-like structures, essentially saying they achieved their high yield through giving new investor money to old investors. Well, that sparked the interest of federal prosecutors. So the next day, a federal probe came in and reached out to Icahn Enterprises. Now, we should note that is not necessarily unusual for what happens when a short report like this comes out, but it is very heavily weighing on the stock today. You can see that stock has been down significantly now since this short report came out, down about 40% since then, and that has impacted Carl Icahn's net worth. Carl Icahn's net worth is also down per the Bloomberg index, a similar amount, about 40% there. So still to be seen here, Akiko, as far as what happens next, but right now it's certainly weighing on shares of Icahn Enterprises.
Yeah, when that story first came out, Josh, we were talking about the impact on the stock largely because it is Hindenburg and we know what they have done to other companies they've shorted before. What's the next step?
Yeah, so I'll start with sort of what Icahn Enterprises is saying right now, right? So Icahn Enterprises came out in the filing and responded directly to the short report and the investigation, saying, quote, that we believe that we maintain a strong compliance program, and while no assurances can be made and we are still evaluating the matter, we do not currently believe this inquiry will have a material impact on our business, financial condition, results of operations. And so really what they're saying is they don't think this is going to have a material impact. And I did speak to a lawyer that is an expert in this space in short reports. So Patrick Gadsden, one of the co-heads of shareholder activism at Vincent and Elkins. And what he said, Akiko, the key is going to be here is that Icahn Enterprises still have ways, to respond, right? So one thing they can do is if they think that stock is now undervalued, they could initiate a repurchase program. That stock's down 40%, so the stock could be considered, quote, cheap at this point, and Icahn Enterprises could come in and buy their own stock, or Remember something that Carl Icahn did back maybe a decade or so ago now when he bought Herbalife. A third party could come in and say, we think Icahn Enterprises stock is undervalued because this short report doesn't have any truth to it. The stock's down 40%. A third party could come in and also buy up those shares and put the people that are positioned short on Icahn Enterprises in a little bit of trouble.
Wow, well, this one will be one to watch. I mean, Icahn, usually the agitator, now he being agitated. Thank you, Josh. All right, we are just getting started here on Yahoo Finance Live. Coming up, we check in with our Shauna Smith at the Goldman Sachs Industrials and Materials Conference as she catches up with Clean Harbor CEO Michael Battles. Plus, consumer spending is softening, and Bank of America is out with a new note detailing where people are pulling back. We'll have the details. And the happiest place on earth set to report earnings after the close today. We break down everything you need to know from the parks and media giant later in the show. Stay with us. Welcome back. It is day 2 of the Goldman Sachs Industrials and Materials Conference. And Yahoo Finance's Shauna Smith is speaking with leaders on what the current economic climate means for their businesses. She joins us now with Clean Harbor CEO Michael Battles. Shauna, take us away.
Thanks so much, Diane. Mike, thank you so much for being with us here this afternoon. So we're wrapping up day 2 of Goldman Sachs' conference. And my takeaway so far is that the sentiment and the theme is very, very bullish. What's your assessment of the industrial economy right now?
Well, Shauna, thanks for having me. And I think that it's certainly our pipeline still remains very strong. We see a lot of waste in our network, and I think that our order book still is still booked out kind of all summer long. So I really don't see any slowdowns in the industrial economy just yet.
And when you talk about what is driving your business, your stock has been doing very well since the start of the year, up nearly 40% over the past year. You just released earnings beating on both the top and bottom lines. One of the standout sectors was your environmental services segment. What's driving that growth, and how much does pricing have to do with it?
Pricing is a big part of it. Also, we're getting a better mix of more high hazardous waste streams into our network, which is driving a better price point. But price is important. Our costs have gone up. We've been forced to raise price, and also as we raise price, we have to look at our cost structure and maintain a lean and mean cost structure to drive profitability.
Are you seeing some of those inflationary pressures easing at all?
A little bit on some of our, maybe on drums and on solvents, but certainly our wages, they're not going backwards. Our cost of materials aren't going backwards. And so we're still feeling that pressure. I haven't really seen a lot of that yet.
And when we talk about your Safety Clean division there, I know there has been some sector-related challenges within that division. What does that outlook look like for the remainder of the year?
We feel good that, where we landed today is going to be we'll be able to deliver on that number. I think that it's, when oil prices do go down, it does hurt us in the short term, but overall, we're really bullish on that business over the long term.
And when we talk about some of the macro pressures here, of course, the slowing economy, the risk of recession, and then we have the debt ceiling debate that's going on down in Washington right now. How are you looking at that just from a CEO perspective and the potential impact a business like yours could have from that?
I think the important part, Shauna, is to maintain a strong balance sheet. Mm-hmm. And I think that if there is kind of recessionary pressure down the road, debt ceiling, different crises, some companies may not come out of that looking so good. And I think that we'll maintain a strong balance sheet to be opportunistic to do acquisitions or things like that if they come to pass.
We were just talking to Joe Ritchie of Goldman Sachs, and he was talking about how when we speak about this bullish environment right now for your sector, the unprecedented investments that we are seeing, the reshoring efforts, regulatory environment right now, how do you see that playing into Clean Harbor's playbook here going forward?
So I'm not sure if I call it reshoring. I'd say it's shoring, because what's happening is that, and I can't explain like kind of every single customer's examples, but certainly as you think about our larger customers, their demand is picking up. And is it because the macro factors are there, or because they're not doing as much internationally and more doing production in North America? Because we're certainly seeing that type of volume into our network.
Are you able to keep up with the demand that your business is seeing?
In certain areas we are backed up a little bit because we are seeing an unprecedented amount of demand. In certain areas we've been doing a great job of hiring and training our people. We're up over 1,300 direct labor headcount, and that's really been able to service our customers well.
Speaking of that hiring count here, it was very impressive. I was reading through your latest earnings release there. In terms of your hiring efforts, are you having trouble finding some of those workers given the fact that you have such a need to fill that headcount?
The answer is we've had trouble. Our turnover, it's not just hiring people, it's retaining the people we have. And we are lowering our turnover rate down to pre-COVID levels, which has been terrific. So in my mind, I think it's as important to keep our own employees and provide a good career path for them as all it is to hire more capable bodies.
What are you doing in order to improve that retention rate?
It's everything, Shauna. It is improving, more holidays, better healthcare costs, providing a career path for our employees, because we are 20,000 strong, and you can move up in the company. My co-CEO started as a driver. And so he moved his way all the way up to this chair.
He started as a driver at Clean Harbors.
He did. And so it just shows you that we do believe we give people chances, and it does provide a great career path for our employees.
Another big theme coming from this conference is technology investment, the role that AI is going to play in your industry specifically going forward. What does your technological investment look like, and are you guys incorporating AI at all? So
we consistently make efforts into our technology. We have one ERP system that runs the entire company, and we continue to make continuous investments, whether that's RPA, whether that's AI, to do things smarter. It's certainly part of the story, but we've been making investments kind of all along into technology, and that continues.
Mike Battles, we really appreciate you taking the time to join us here. Your first time on Yahoo Finance, co-CEO of Clean Harbors. Thanks so much.
Thanks for having me.
We'll be right back.
Welcome back to Yahoo Finance. We are now talking about the spending slowdown. A new report from Bank of America shows card spending is down. In April, dropped to a negative 1.2%. That's the first negative year-over-year reading since February 2021. Joining us now is David Tinsley, Bank of America Institute senior economist. David, good to talk to you today. You look at the numbers here across the board. Where are you seeing the slowdown most pronounced?
Thanks for having me on. Yeah, I mean, the great power of this data is we're using 67 million customers, consumers and small businesses to really add real-time insights on the US economy. And where we're seeing the slowdown, well, first of all, broadly, you're exactly right. There's been this broad slowdown in consumer spending, down 1.2% year on year. And really, I think there are two messages when we burrow into that. The first is that service spending is slowing reasonably significantly now, and that was for a long time keeping the consumer spending powering forward. There seems to be a slowdown in service spending going on. And then I think the second really interesting point that we can make in our report today using our data is that higher income household spending is slowing. That's down on the month in terms of their discretionary spending, and there's a couple of reasons for that.
I got to ask you, David. So one of the things you point out in your data is the effect this seems to be having on the spending patterns within higher income households. There's been talk that should a recession occur this year, that it may be a white collar recession. What does your data tell you?
Well, this is really interesting. So what we're seeing is that when we use our data to look at unemployment payments into people's accounts, we're seeing that unemployment payments into people's accounts are rising 5 times faster for higher income households than the lower income households. So these are from pretty good levels, of course. The labour market overall is buoyant. But nonetheless, it looks like the higher income households are just feeling the chill a little bit more severely than some of the other income cohorts. And I think the other point is that when we look at wages and salaries in our data paid into people's accounts, we're seeing actually the level of wages and salaries on higher income households falling about 1.3% relative to April 2022. So they are also feeling, in terms of those in work, weaker wage growth. And that's all adding up to a slightly weaker picture for the higher income households.
When you look at that specific bracket, what are you seeing in terms of savings? Because the story over the last few years has been that savings rates have been relatively elevated because of the pandemic. Are you starting to see that chip away even in the higher income bracket as well?
Well, this is the good news, really. So we're being a bit gloomy here, talking about household spending momentum failing. But the great news, really, is that when we do use our data to look at the deposit levels in people's accounts, we're still seeing those up 40 to 60%, depending on the income cohort, relative to the pre-pandemic period. So, that you can take some good silver lining from that although there's some slowdown going on, people's sentiment and perhaps the degree of slowdown will be buffered by those savings.
So, David, as we know, consumers are often considered the backbone of the U.S. economy because of how much they make up GDP. So what does, for instance, today's inflationary data tell you about the potential for the consequences on the consumer?
Well, when you look at the inflation data today and you compare it to what we saw on card spending, you're basically seeing real spending in our measures declining somewhat. So it's telling us really that the household sector is still feeling quite a lot of pressure from those higher prices. The trajectory over the next 6 months, we'll keep looking at the data to assess that. As I say, the household buffers, that's a relatively positive story.
So what does that tell you about the mindset then?
Well, what's interesting is when we asked people in a survey we did, a proprietary survey on people's assessments of how much rainy day savings they have, you see that coming down a little bit. So in other words, people are beginning to think, well, inflation is running fairly high, so my rainy day savings won't last me as long. But as I say, going into this downturn, these levels of buffers are really pretty comfortable.
So often we saw over the past couple of years, we saw some spring back in spending, particularly in the summer as we got the chance to basically go outside again. What's your expectation based on what this data is telling you now about what to expect this summer?
Yeah, that's a good question. So the data is always choppy and we can't read too much into monthly data. What we are seeing in April is weaker airfares spending, quite weak lodging, but restaurants and food a bit stronger. So I think it could be that relative to last year, where there was a very strong unwind from people being cooped up at home, they went out, they traveled the world, they really enjoyed that pre-pandemic, that post-pandemic boost. I think perhaps relative to that, the spending will be a bit cooler, but it may. There may be some continued momentum going into the second half still.
All right, David Tinsley, we will continue to watch and see if the consumer remains strong or if they start to weaken more. David Tinsley, thank you so much. Switching gears, Occidental Petroleum in focus today after reporting weaker than expected quarterly results. Keep in mind, Warren Buffett shot down speculation about taking full control of the oil company. He shot down that speculation over the weekend. Inez Ferre joins us now, though, with fresh details from the company's earnings call. Inez, let's get right into this. What are your top takeaways from the call?
Yeah, Diane, the top takeaways are, one is that the miss on the top and the bottom line really overshadowed production for the company, which is something that Occidental Petroleum Management highlighted on the call, that production topped its midpoint production guidance for the first quarter. The company raised its full year production guidance. CEO Vicki Hollub highlighted Oxy's strong well performance in the Permian Basin and also Occidental's highest quarterly production in over a decade in the Gulf of Mexico. The second point, and I would say that this is probably the most important point that was over and over talked about during the call, is that Occidental Petroleum is prioritizing spending money on share buybacks. And one analyst asked executives if excess cash flow, whether the company would put that towards share buybacks or perhaps towards growth. The answer was share buybacks. Vicki Hollub saying any incremental cash flow that they generate would go to share repurchases, and beyond that, the redemption of preferred stocks. Now, it's notable that the company spent about $750 million on common share buybacks. That accounts for more than 25% of its $3 billion share repurchase program. And that triggered the redemption of preferred stock to the tune of $650 million. Now, management said over and over that their capital is disciplined, their strategy is disciplined, agnostic of the commodity volatility, and that they are very committed to these share buybacks. And then the last thing that I would highlight from the call is inflation, their commentary about inflation, and basically saying that they are seeing signs of tempered inflation. Yes, there is still wage inflation, but they are seeing sort of a plateauing, so to speak. And they are also talked about partially offsetting inflation pressures by faster completion of pumping, operational efficiencies, and reducing certain operating costs.
So Inez, time to get to the vibe check. How do you rate the call?
Yeah, I would rate it a 1 for being on message, on point with the share buyback. That is a priority of theirs, and they will continue to do that, and that will trigger the redemption of preferred equity. So yes, on point for that. Definitely got the message across.
All right, Inez Ferre with the latest on Occidental Petroleum. We'll continue to watch that one. Thank you so much, Inez.
Thanks.
All right, coming up, we check in on a few trending tickers with 30 minutes left in the trading day.
right, it's time for Triple Play. 3 stocks we are watching in the final 30 minutes of trading. Celsius, Roblox, and Paramount, the big picks today. I'm going to kick things off with Celsius. The energy drink company blasted past expectations with earnings more than quadrupling in the first quarter and the stock being rewarded in a big way, up more than 20%. The first quarter revenue surged 95% compared to the same period last year, with sales in North America accounting for 96% of that mix. Now, those numbers prompting a number of upgrades today. Wedbush analysts lifted the company's price target from $115 to $130 a share, maintaining its outperform rating on the stock. Bank of America upgraded the stock from a hold to a buy with a price target of $125 on the stock. And Diane, when you think about the market share for Celsius in the U.S., still at 7.5%, but that is double where it was a year ago. So they've been making big inroads in the market.
Indeed. I mean, Celsius certainly got a boost. I mean, it looks like a caffeine boost in shares
today. No pun intended.
Right? Exactly. No pun intended this time. Yeah, and I mean, it certainly put some things in the rear view mirror with regard to the troubles it had. I mean, it definitely wasn't in as much favor last year. Certainly popular and everyone piling in today. I mean, and it's definitely even put some legal issues that it had in its rear view mirror. I mean, they had to deal with a settlement at the start of this year with claims with regard to they were sued for claiming no preservatives in their drink. I mean, they would argue that the issue that was in play was not a preservative, but they've put those issues in the rearview mirror.
Yeah, and I would just say the brand recognition, the growth of that's been super impressive to me, especially in a space like the energy drink market, which is so crowded with these legacy competitors. So that stuck out to me, and they actually cited that brand awareness as a core catalyst in helping to drive that all-time quarterly record revenue growth to $260 million in sales. So I think the momentum is just right for Celsius to continue.
Right. My play is Roblox. Shares popping just shy of 9%, shaking off a quarterly loss of $268 million or 44 cents a share. While that was worse than expected, investors are cheering user engagement numbers. My kid is one of them. Average daily active users rose 22% on a year-over-year basis to 66 million. Engagement hours were also up, and bookings, meaning sales plus the change in deferred revenue from online purchases, or put more simply, Robux. That, again, was giving just basically a green light to Wall Street today. So, I mean, I've contributed to this here with my kiddo. Yeah. Sadly.
Well, Dan, you're talking about your kids using it, but here's an interesting number that stood out to me with the earnings. They say older users are continuing to contribute the most. But older users, the age group we're talking about is 17 to 24. Obviously, Roblox, huge with the kids, as you say, but certainly they're getting a big lift on that front too. And I also thought it was interesting to hear what the company had to say about potential cuts, because that's been such a focus within the tech space. We've seen so many layoffs there. Roblox saying that they are pretty comfortable with where their headcount is right now, and so it doesn't look like we're going to see any additional cuts, at least not right now.
Yeah, I was surprised by that.
Yeah, and just thinking about the metaverse and how all these big tech companies, from Microsoft to Meta, they've really tried to enter this space and have struggled. You have Roblox really being the leader here, continuing to engage those users. Akiko, you were just mentioning how they want to attract that quote-unquote older demographic between 17 to 24. If we take a look at the average amount that people spend in the app, that was around $11.70 in the quarter, slightly pretty much on par with the year ago period, although a slight deceleration from Q4 during the holiday season. Maybe parents gave their kids a few extra months.
We did.
Yeah, because that was around $15. So it's just interesting to see the growth of this company. But moving on to my triple play, that is Paramount. Shares dropping today, down about 4% after the company cut 25% of staff in its domestic cable networks and shuttered its long-standing MTV News division after 36 years on air. The news comes after the media giant unveiled a restructuring plan that combines Showtime with MTV Entertainment Studios. The company, which also announced it would merge Paramount Plus and Showtime into one streaming product, is eyeing greater integration between its cable TV and streaming exciting offerings, especially amid those escalating cord-cutting trends. But remember, guys, that just last week, the media giant reported disappointing earnings and included a $511 million direct-to-consumer loss. It also slashed that quarterly cash dividend of 5 cents a share, down from the prior 24 cents. So a major slash there. It sent shares plummeting nearly 30%. Clearly, there's just so much going on at this company right now, and it's not in the best position.
Yeah, I mean, you guys know this is my old parent company, so I'm not surprised to see these challenges, and especially with their latest quarterly report, as you just mentioned, Allie. It was clear that there were some struggles, so I knew there would be cost cuts coming. But it is on the sentimental side. I mean, it's just sad to see the end of an era, especially for MTV News. I mean, I grew up with that, so, you know, so that like hurts my heart. And of course for the people too, but just the sentimental aspect really hits me.
Yeah, RIP. There's a lot of people, I think, Diane, that are saying that today. You know, Allie, I've been curious here with so many of these companies reporting earnings. A lot of the focus, yes, is on their performance in Q1, but also what's happening right now with the writers' strike. We know the Directors Guild is now in negotiations here. Their contract expires at the end of June. How does that complicate the picture for studios like Paramount?
Well, the general consensus among the executives, at least on these calls, is that right now they have enough content banked when it comes to the writer's strike that it'll keep them afloat. But if we see this strike continue into the fall, that is certainly going to impact projects and ultimately their bottom line. As you were saying, that Director Guild, they're currently in negotiations. That 3-year contract expires June 30th. And it's a lot of the same issues that we heard from the writers, a lot having to do with the streaming boom, those streaming residuals being less than traditional cable. We'll see, but this is the first time in 15 years that we're having the DGA negotiating at a time when these writers are striking, and they did warn their members that these talks could get contentious. So the general consensus is right now it's okay, but I think the longer this goes on, the more of a risk it's going to be.
Yeah, indeed. We'll continue to watch those guild negotiations. Thanks, Allie. Coming up, it's been a choppy month for markets. Stay tuned to hear what our next guest is saying about investor sentiment. That's on the other side. It's been a choppy month for markets between the Fed decision and the debt ceiling showdown. Investors are showing those signs of what our next guest says. It's, quote, tepid bullishness. Joining us now is ETF think tank director of research Cynthia Murphy for this ETF report brought to you by Invesco QQQ. So let's get right into this, Cynthia. Tell us about the leadership. Where is the leadership right now in this kind of market?
Yes, to your point is choppy market is the best way we can describe. You know, we have the numbers are looking somewhat positive, and it's fueling this sense that, you know, maybe things are better. You know, we saw at the last statement from the Fed that, you know, maybe we're coming to the end of this really difficult period. And so we see some momentum there. But when you look at actually what's leading the markets higher, the S&P 500 and Nasdaq 100, I mean, we're talking about 5-6 stocks that are doing all the heavy lifting. Companies like Apple, like Microsoft. So it's a very, very narrow leadership. And you see that in volume. You see that even in ETF flows. I mean, people tend to turn to ETFs when it's a difficult market to navigate because you can be very tactical. You can be very nimble. And if you look at just the amount of money going into ETFs so far this year, you know, we've picked up about $110 billion. That's 40% less than we saw at the same time last year. So the inflows are slower, which tells people are very cautiously optimistic about what's ahead, you know, because of all the headwinds we see in front of us, this debt ceiling conversation, you know, the inflation that came down a little bit, but it's still sticking around 5% and not really budging. And so there's a lot of concern about, is there a recession coming? So it's 1 foot in, 1 foot out right now on this market.
So we always hear about narrow, you mentioned narrow leadership, but the key, I'd imagine in a market like this is really diversification. You mentioned sort of a slower inflow right now, but where are those inflows going?
So for the most part of the year, it has really gone into two places, fixed income and international equities as a better value play relative to the U.S. In the last week to two, we actually saw money going back into your tech, your growth names, your QQQ, your XLK and XLC, tech and communication services, which are the sectors leading the S&P 500. So we're seeing a little bit of enthusiasm over the growth names, and it's not clear why, because if things go the way they are, if recession hits, these companies are on the line to have some pain ahead. But there's so much enthusiasm over artificial intelligence. There's a sense of things happening in this space. Their earnings haven't been, you know, disappointing necessarily in the tech space so far. Maybe it's because they've had a lot of layoffs, but the point is the numbers look somewhat supportive. So we're seeing some money go back into the riskier part of the market in terms of your tech names, your big growth names. But we have to see if that's going to stick. You know, I think this debt ceiling conversation is going to give us a better sense of what happens to the risk-free rate going forward. And then we'll see if people will resume to their fixed income, look for safety, or they're going to put both feet in and pursue the growth, the riskier assets.
Cynthia, where do you think that move into growth is coming from? What's fueling it from your point of view?
I think it's two things. One is, right now the market is pricing that we're going to see a rate cut already this year. The last I read was like 99% chance of a rate cut. You know, rate cuts would really be supportive for the growth names, which have been kind of in the back burner because we've been in a rate hike scenario. I think all this conversation of innovation, all this enthusiasm of AI could be also supportive for the space. There's a sense that, you know, it's a sector that's still out there. It's innovating. There's new things coming. So this is where growth is going to come from. This is where the opportunity is. And then earnings haven't looked bad. So far, no company in the tech space has really disappointed or surprised dramatically on the downside. But, you know, there's also been a lot of layoffs. So I think it's just a way people are, maybe we're willing this market higher. We want to be past this phase. But, you know, it's unclear whether we are going to get away without a deep recession or not. So it's kind of tentative right now.
Yeah, so let's look on the opposite side of the spectrum. Energy, the best performing sector last year. We've seen significant pullback this year. What are you seeing in terms of inflows for ETFs there?
Yeah, energy and financials, right? Really struggling right now. We're seeing a lot of money coming out of that space. and it's really last year's play, not this year's play. But what's interesting is, if you look at these more defensive plays, you see gold is an interesting story, because you have gold and Bitcoin, which you could argue both of them kind of playing the same playground, and you have both of them doing really well this year. And one is your absolute safe haven play. The other is your super risky volatile play. It's a very risky asset, but they kind of both are combating this concern about banking crisis, financial concerns. So it's really interesting, because if we are to kind of try to summarize market sentiment, it's really impossible, because you have both bulls and bears pulling on both sides. And it's really so data dependent at this point that every day we have a data point, everybody's watching to see what comes next.
ETF think tank director of research, Cynthia Murphy, good to talk to you today. Appreciate you stopping by.
Thanks for having me.
Well, coming up, Google kicking off its annual I/O Developers Conference. We're going to catch up with our very own Dan Halley, who is on the scene with the latest announcements. That's coming up after the break. Well, Google kicking off its annual I/O Developers Conference today, and CEO Sundar Pichai had plenty to say about big tech's latest obsession, generative AI. Yahoo Finance tech editor Dan Halley is at the conference and has all of the details. Dan, this comes at a time when there's real concern that Google's lagging behind OpenAI, even Microsoft, when it comes to generative AI. What are we hearing about how the company plans to integrate the technology in their products?
Yeah, Kiko, we're here obviously at I/O, in case you can't tell from that giant I/O sign behind me. But I mean, really, there were three themes here at Google I/O 2023. They're going hard on AI. They're not leaving behind businesses. They're going to continue to focus on those. And they're talking about AI safety. So just to kick things off, I mean, they really went in on how they're going to be bringing AI, generative AI, to search. This is something that they've been kind of telegraphing, something that Microsoft already does. They've already integrated generative AI into their Bing search product, and that is where Google started to look like it was falling behind. So a big announcement here with that, though it's important to note this is still a test. You're going to have to try to get in on a wait list, so it's not as though you're going to be able to use it right away. They also discussed more about their Bard chatbot. They're going to allow everyone to start using that now. It's available in multiple languages, and it'll work just like Microsoft's Bing. So another announcement there. And then they talked about how generative AI is coming across their products, whether that's a Workspace, the actual messages texting app for Android, the ability to change your wallpaper on Android, and across a number of other products. So really the big thing here was generative AI and how Google is putting that across its products. And just, the business aspect of that being, as they were discussing the search product and Bard, they were sure to point out that advertisements will be a part of that. So you'd be able to do a search in Bard or in Google with the test generative AI capability, and then you would actually see some of those ads show up underneath that generative AI area. So they want to ensure that while they're offering this product, while they're matching or exceeding potentially what Microsoft has to offer, they're not leaving behind their core business, which is advertising.
Dan, you mentioned another tech giant there, Microsoft. According to a Reuters report, antitrust regulators in the EU are now actually expected to give a green light next week to Microsoft's deal to buy Activision Blizzard. So a little bit of a pivot from what we're talking about. This comes, though, after the UK blocked the deal. What happens now?
Yeah, look, this is still very much in flux. Microsoft could go ahead and probably will go ahead and try to appeal the UK's decision, but the EU carries a huge amount of cachet with it, right? If we have the EU saying that it's okay, if we have Japan saying that it's okay, and other jurisdictions as well are saying, look, Microsoft can move forward with this, then it might put a little bit of pressure on the UK as far as that eventual appeal goes. Don't forget, though, the FTC is also suing to stop this here in the US. So Microsoft and Activision still have a number of hurdles to get over before they can complete this $70 billion deal. If it goes through, it would be Microsoft's largest, and it would be absolutely huge for the company as far as its gaming enterprise, because it would be able to then build out both its mobile and cloud gaming. And the reason why the UK said they blocked it was because of a potential threat to the cloud gaming space. Microsoft is the leader in it. It's still very, very early. Google tried to get in and already bounced. Amazon is in there still. NVIDIA's in there as well, and Sony's still trying to catch up. But if Microsoft can somehow manage to turn around the UK and FTC, it could be a major win for them.
Worth noting, by the way, Microsoft shares, they're hitting a new 52-week high today. Dan Halley, in his element, out there in Mountain View. Thanks so much for that from the Google I/O conference. Well, coming up, we are counting down to the closing bell on Wall Street. Stick with us right here on Yahoo Finance Live.
We are minutes away from the closing bell on Wall Street, where market action has been mixed. Let's bring in Yahoo Finance's Ines Ferre to break down today's market action. Ines?
Yeah, Diana, and it looks like the Nasdaq is going to be the winner for today, up about 1%. If we take a look at our Wi-Fi Interactive, the Dow slightly lower, the S&P 500 up about 0.4%. In fact, year to date, I'm going to pull up the Nasdaq so you can see up 17% year to date. Looking at the sectors, the winners today being technology and real estate, utilities, energy, the big laggard for today, as well as financials. Over on the Nasdaq 100, Microsoft up more than 1.5%. Microsoft today, by the way, hitting a 52-week high. Also, Amazon up more than 3%, and Alphabet up more than 4%. Taking a look at what's been happening with energy prices, I mentioned the energy stocks are lower. Well, crude oil today lower. WTI down more than 1%. Brent crude also down more than 1%. And checking out the gold futures, that's also lower today after today's inflation print. Here's the closing bell at the New York Stock Exchange.
You see the closing bell right there at the New York Stock Exchange. A bit of a split picture to end the day, pretty much what we have seen throughout the day today. And the Dow really the only laggard, although it did bounce back from the lows there. Interesting to watch that today as we got that CPI data. Inflation, or at least pointing to inflation moderating there, was only up about 4.9%. When you compare it to where it was in March, it was at 5%. And yet investors still not convinced that this will necessarily slow the Fed there. And we saw some big moves in Treasuries bonds there as well on the back of that. Now, Inez mentioning tech, one of the big winners on the day. We have seen names like Alphabet and Amazon move in a big way, but shares of Airbnb moving in the opposite direction. Take a look at where it ended the day, down nearly 11% after the company delivered a cautious outlook for the year. CEO Brian Chesky joined Yahoo Finance this morning, and he had this to say about the pressure the company is facing amid rising prices. Take a listen.
Over the last year, with inflation, people have less money to spend on travel than they did a year ago. And now, rising fuel costs mean that it's even harder and more expensive to fly. And so we're seeing that people are much more price conscious. That is a big focus on us. And we have been seeing a little pressure in North America, especially. So really trying to make sure that average daily rates don't continue to go up, perhaps even go down, by making sure we have enough supply, we have enough discounting tools, we show upfront pricings, which steers people the best total value.
Airbnb did top earnings expectations for the first quarter as bookings grew 19% year over year. But Diane, that last point that Brian Chesky made about ADRs potentially slowing, that was the big concern here. It's an interesting dynamic for the company. On the one hand, as an investor, you want to see that continue to go up. And yet Brian Chesky has continued to say, look, we are seeing the consumer be a lot more price conscious.
Yes.
We want to meet them right where they are. So we may have more supply, more bookings, but that doesn't necessarily mean those rates are going to push even higher.
Right. Yeah, I'm not surprised to see the impact on the stock today, especially given this outlook and the cautious note that Chesky was sounding. I mean, look at it. We're looking at it down nearly 11% on the day, especially because you consider this is heading into the summer season. Summer should be a strong season for a company like Airbnb, but they are confronting a consumer that is more, just taking other things into consideration when they're making decisions about where they're going to do their bookings. And you even just hear, generally speaking, on an anecdotal basis, chatter of people returning to hotels, preferring to go back to the hotel model instead of the Airbnb model. So again, you're seeing that reflected in how the shares are moving today.
And Dan, just one more point to make here. Chesky did say, look, we know that hotel prices may be going up. That's why we want to push for lower. I mean, at least that's what we're hearing from the company. They recently announced rooms. They're trying to bring the price point lower at a time where they know people are still going to be traveling, but they're still a little more price conscious.
Right. All right. Let's switch gears to a company that ended in the green. Shares of Roblox ending the day on the plus side, up nearly 7.5% after the gaming platform posting a beat on revenue expectations for the quarter. It did post a loss, but that didn't matter. Here's why. Average daily active users and engagement hours both up over 20% year over year and our all-time highs for Roblox. And Akiko, I talked to you about this before. I mean, I've seen that kids are, really into this platform. I don't get it. I watch my son who's very into it. But what surprised me, and you mentioned this before, is seeing the older demographic, or what they call the older demographic, being engaged by Roblox.
And can we repeat that demographic again? 17 to 24-year-olds.
Yes,
That's considered old. But to that point, I mean, I will say, I'm going to defer to you. You're the expert on Roblox.
Now,
I would say anybody with kids are. But that's interesting to see that engagement continuing to be there because, look, Robux, right?
Yes,
I mean,
Robux. That's what I spend. I mean, I don't spend. I set boundaries on it. I mean, my kid asks for Robux, and I'm like, okay, you can have some now, but it's not. I'm not doing this every month or every day, kind of thing. So you have to set certain boundaries. And I mean, somebody made this note on Twitter. Tyrone Ross made this note about how that's where kids' allowance is going now, to Robux instead of, I mean, kids. Every one of us, from kids to adults, operating in more of a digital world now, and I can see why it's sticky in terms of how kids are engaging with it compared to, say, Nintendo, Super Mario. There's something about Roblox that just pulls them in.
I say we bring your kids in for the next earnings report on Roblox.
Yeah.
Another stock that we're watching today, shares of Perrigo, the stock spiking midday after an expert panel recommended the FDA allow women to get access to a birth control pill without a prescription for the first time in 60 years. Let's bring in Yahoo Finance's Anjali Kamlani, who's got all the details for us. Anjali.
That's right, Akiko. Historic day for women's health, a historic milestone at the least, with this advisory committee voting in favor unanimously in a 17-0 vote to allow Opill, that's Perrigo's birth control pill, to be available over the counter without a prescription. Now, in a quote from the company's CEO to Yahoo Finance, they said today's vote is a new groundbreaking chapter in reproductive health, and Perrigo, noting that they are leading the way in making contraception more available to women. This, of course, comes at a time where we're dealing with the impact of the overturning of Roe v. Wade and a lot of concern over the access to abortion pill around the country. So this is one step back from that in birth control itself. The business opportunity is quite huge for the company, according to JPM, $100 million opportunity, not currently accounted in current guidance. And they're seeing the market as mostly uninsured women between the age of 15 and 49. So that's about 10% of the population right now. And of course, we know there are other channels as well that could potentially benefit from this. When we heard from the advisory committee members, there is some concern about the FDA and their concerns looking at potential access for adolescents, so that younger portion of the population, as well as individuals who might have, conflicts with medication or the like, and whether or not they might be able to access that. To that point, one of the voting members, that's Dr. Evie Epsi from the chair of the University of New Mexico's Department of Obgyn, said, quote, "It would take a very high bar of concern to justify non-approval of over-the-counter status given what we know about the medication." And then another voting member, Dr. Leslie Walker Harding, saying that, she would not really support any restrictions on adolescents. But again, it is up to the FDA, the final say. And JPM analysts did say that this puts a lot of pressure on the regulatory agency now to make a decision, which we expect to happen sometime this summer.
All right, Anjali, our thanks to you. Let's switch gears really quickly. JP Morgan Chase CEO Jamie Dimon is warning lawmakers about the risk of debt ceiling brinkmanship. In an interview with Punchbowl News' The Vault, Dimon warns about causing panic in the market, saying, quote, "People panic, and when you see people panic, that's 08, 09 again, and that's really what you want to avoid," end quote. Joining us now is the person who conducted that interview, Brendan Peterson, author of Punchbowl News' newest newsletter, The Vault. Take us through some of the takeaways that you had from your interview with Jamie Dimon.
Thanks so much for having me. When I spoke with Jamie Dimon, the first thing I asked about was the debt limit, because for Congress, that's still the biggest story in town right now. And he was pretty adamant. This does feel a little bit different this time around. The politics are a little bit more pitched. He said that there is a higher chance that Congress makes a mistake here, whether or not that is allowing a full default of the government's debt or just getting so close that, like you said, markets begin to panic. Obviously, there's a lot of political reasons for that. Kevin McCarthy has a much smaller margin of control in the House than John Boehner did during similar episodes in 2011. And so you have to wonder whether or not he's going to be able to get any kind of debt ceiling raising bill through his chamber that doesn't have all these conservative wish list items like the Limit, Save, and Grow Act did, which passed out of the chamber earlier this month. Well, we just have to wait and see.
Brenton, I want to pick up on that point you made about Jamie Dimon saying, look, it's not just about getting past the X date. It's about the expectation or the risk of even getting to that date. And you talk about the potential mistake in terms of the politics of all this. I want to point to another quote here from your interview with him. On the default itself, he says, think of it in two pieces, the run up to a default and an actual default. It's even bad to have the run up to default because that can question American debt ratings. I mean, do you get the sense that he thinks that damage has already been done?
That is a really good question. From him in particular, I think he would say, no, not yet. I think when you're thinking about stuff like the ratings that American debt gets from Fitch's and Moody's and S&P at Standard & Poor, obviously, like we're still AAA debt right now. But even Fitch's, and I think other ratings agencies have said this too, they are getting more and more concerned about the impact that, simply put, political dysfunction has on the debt limit debate and just the status of American finance, right? If we got to the point where investors were genuinely concerned that those payments on Treasury's interest would not be disseminated out to the rest of the financial system, that is the mother of all liquidity crises, right? We're not there yet. But I think, honestly, if Congress keeps doing this song and dance, I don't blame them, the credit rating agencies, for beginning to wonder just how sustainable this is. I think that's partly why when President Joe Biden last night started talking about the 14th Amendment a little bit, that line that says the public debt shall not be questioned, that gave markets a little bit of hope, right? Because maybe there's an administrative runaround on this, but we're not there yet.
It's a pretty optimistic outlook, though, right? When you think about what we heard from the president as well as leader Kevin McCarthy yesterday, it doesn't feel like there was a whole lot achieved in that discussion. I realize those weren't, the White House doesn't want to characterize that as negotiations, but Punchbowl News obviously right in the center of those negotiations, seeing the back and forth. What's your sense right now about how close we're going to get up to that X date?
I mean, we're already pretty close is the thing. I mean, when you're talking about the legislative timetables in place, and if we're talking about a June 1st-ish X date, obviously there's a little bit of flexibility built into that figure, but we are already at the finish line right now. And so if there are going to be movement, if there's going to be any progress, and whether you call it negotiations or whatever, it has to happen really quickly. It has to happen this week. Thankfully, we do know that staffers from Speaker McCarthy's office and the White House have been meeting today in Speaker McCarthy's office. I just walked over from the lobby outside. Those conversations are happening. We don't exactly know how well they're going. And then we're going to have another principals meeting with McCarthy and Biden on Friday. As soon as that happens, we'll know just how likely a deal is going to be. I think for right now, it's a lot of waiting and wondering, which is probably why markets haven't quite lost their minds. If we get to the point of after this week where there's no deal, I think it's fair to begin to wonder how the markets are going to react and how quickly they might go haywire.
Yeah, it could be some more choppiness ahead for us. Brendan Peterson, Punchbowl News. It's good to have you on today. Appreciate the time. Let's get out to Diane now for the very latest on Disney's results in the most recent quarter. Looks like they have some improvement when it comes to streaming losses.
Yeah, they did have some improvement there. We've got the latest results from Disney just crossed the tape. EPS, earnings per share, coming in at 93 cents a share on an adjusted basis. That was a little shy of expectations. Expectations 94 cents a share. Revenue coming in at just shy at 21.8 billion. That was about in line with expectations. subscriptions. They slowed some of the bleeding with regard to Disney Plus total subscriptions. It was 157, just over 157 million in terms of Disney Plus subscriptions. So they stemmed some of that, but the stock is taking a little bit of hit in after hours. So, certainly still some room for improvement there. We know this comes at a time when CEO Bob Iger has come back to kind of right the ship with regard to how Disney operates. And he's been dealing with implementing cost-cutting measures, namely job cuts with regard to just tightening the balance sheet at Disney. So again, earnings coming in on an adjusted basis at 93 cents a share. Expectations again 94 cents a share, so just shy of expectations, but certainly not causing too much of a hit on the stock. It's down about a little over 1% in after hours, Akiko. So we're getting these numbers just in right now, and taking a look at all of these line items. Parks and experiences revenue was $7.7 billion there. That was a little better than expected, actually. So not a lot of surprise there in terms of parks and experiences, with people going back to parks. I mean, I went last year to Disneyland, not World. So not surprised to see some growth there. Hulu and live TV subscribers at 4.4 million. So that was a little lighter than expected. So we will continue to watch that.
Yeah, we're going to keep that conversation going to break down the Disney numbers. More on that still to come up in the hour. But up next, we have some of the biggest takeaways from Goldman Sachs Industrials Materials Conference. That's coming up on the other side of the break. Stay with us. Well, we got new data out this morning pointing to some relief on inflation. Consumer prices rose 4.9% year on year in April, marking the 10th straight month of cooling. But with prices still at historically high levels, there are increasing concerns about a recession. Our very own Shauna Smith is at Goldman Sachs Industrials and Materials Conference, where she spoke to Joe Ritchie, the analyst who covers the sector for Goldman. about the economic challenges we're facing today. Take a listen.
Today, we are in the start of a very significant, infrastructure build in the U.S. Some might call it a U.S. manufacturing renaissance. I've been, covering this sector for a long time. The level of spending that's occurring today is unprecedented. And you can think about, semi-capex investment, over $400 billion is being planned. There's a lot of stimulus packages at this point that haven't been spent. And so the tone coming out of the conference the last 2 days has been very bullish.
And it's interesting, given the time that we are in right now, the risk of recession, what happened, what's still going on with the regional banks, of course, and then also you had the showdown down in D.C. over the debt ceiling. Has there been any cause of concern or any tone that maybe that could be an issue here for these companies down the line?
At this point, from a fundamental perspective, not yet. We asked every company, and we had about 20 companies, our own, multi-industry coverage that I'm responsible for here over the last 2 days, and not one of them is seeing any signs of real credit tightness in their business today. Your question around the debt ceiling, clearly that's more of a technical issue for the market. And if you go back to the last time that we had, crisis was really back in 2011. Yeah, there was some volatility in the market during that time frame, and I would expect there to be some volatility again this time around. But purely from a fundamental perspective, our companies aren't seeing it yet.
When we talk about who is best positioned in this environment, who would that be from your coverage list?
Yeah, and so, I had a lot of companies that were bullish. I would say that going into the year, where I felt the most bullish was really around the companies that were building products companies that were interest rate sensitive, that also had an opportunity for really secular growth opportunities beyond just this year. The HVAC sector is a really attractive sector. It hits all of those different buckets. Johnson Controls was a name that we had here today. And they're a company that last year also had some struggles because of supply chain issues. We're about a year in anniversarying some of the issues that they had, and this quarter marked an inflection where you're starting to see an easing in supply chain, and ultimately that's having a really powerful impact on growth. And that's not just a Johnson Controls specific comment, that's across the industrial sector. And you saw a lot of companies within my sector actually raise guidance, but I'd say if I had to pick one, it's ticker JCI, Johnson Controls, but there are several others that I can mention as well.
When we talk about the reshoring efforts, the investment coming from the government here in terms of manufacturing in the United States, how big of a factor is that for these companies in the near term?
Yeah, honestly, I think it's going to be huge. And so a lot of the leading indicators that we take a look at when we take a look at there's a Dodge index that will measure the value of projects that are breaking ground today, and those are projects that you're not going to see in the P&L until 12 to 24 months from now. And that index is up over 100%. And so clearly a tremendous amount of investment. You'll probably start to see some of that in their revenues and in their profitability as we progress through the year. But importantly, this is about it being a multi-year tail. And so one of the concerns that investors have today is that backlog is peaking, orders are decelerating, and typically you don't like owning industrial stocks when that's happening. But we've taken a little bit of a different view, more forest from the trees. And ultimately, what this is going to result in is as we progress through the year, a lot of these companies are going to end with very good backlog and 2x the visibility that they normally have into the next 12 months sales. And so we think it's going to be super important.
Joe, one of the common themes that I've been hearing amongst the fireside chats that I've been sitting in on, and also with the CEOs that we've been talking to, is technology investment and how that is so key going forward in terms of productivity and really to get the competitive edge against others within the space. What are you hearing on that front? And I guess, what do you think is the most important initiatives that you're hearing from these companies?
Yeah, so this discussion about IIoT, or the industrial Internet of Things, has been something that we've been talking about for a decade, right? And I've thought about it as being more about evolution, not revolution, and ultimately how it changes the service models for a lot of these companies. And so I go back to HVAC. I had a couple of HVAC names here today, Johnson Controls, Carrier, and they're both talking about double-digit service growth going forward. Now, what's allowing them to feel confident in that is that still a small percentage of their installed base is connected. So they're continuing to connect that installed base. And as they connect the installed base, they're getting more data. And that data is allowing them to be more predictive with their maintenance of their own equipment. And so, clearly AI is going to be something that comes next. And I'm sure that, when everybody starts talking about their digital offerings and how that's going to evolve going forward, AI is going to be a centerpiece. Still too early at this point. But I would say that just the connectivity of assets is going to be super important going forward.
When we talk about some of the issues facing the sector and many of the outlooks from the street heading into the year, we talked about labor shortage, and not just for industrials and materials. This is really across many industries. What are you seeing from that perspective? How big that challenge is here for these companies at this point?
It's easing. It's easing. So we have a few companies that talked about that today. And last year, the one that comes to mind for me was a company called Lennox International. They're also an HVAC player, and they were seeing real issues with a particular facility in Arkansas. And this past quarter, the margins in that business expanded substantially. One of the reasons for that was the fact that labor has become less of an issue. And so the labor market is still tight, and clearly there's still a competition for labor, and that's causing, wage inflation to remain sticky. But that being said, you are seeing a little bit less, tightness than we saw about a year ago.
Let's bring in Shauna, who's been live on from the conference for us all day. Shauna, I'm curious to get your takeaways from the conference. It doesn't sound like the expectation is the economic conditions will get much worse, but not much better.
Akiko, going into this, I thought that was going to be what the CEOs were focusing on, but they were even more optimistic than that. I felt like every conversation I had throughout the day, CEOs, business leaders, even analysts seemed to be getting more and more positive. I don't know if they were feeding off the energy of each other, exactly what was driving it, but they do seem to be bullish at this point. And it is a bit surprising given the fact that we are seeing the economy slow down. We do have this looming threat of a recession, but the takeaway here was almost like, what recession is everyone worried about? They're clearly seeing investments coming in. One of the big catalysts here in the industrials and materials space, obviously, is the unprecedented investment driven by the CHIPS Act, the Inflation Reduction Act. The focus there, what exactly that's going to do for growth within this sector is something that we heard throughout the day. RXO CEO Drew Wilkerson, the truck brokerage company, saying that they're already seeing a pickup, or really so much steadying in volumes here, which we know is such a key data point here for a company like that. They expect to have that trend continue and even pick up in the second half of the year. Mike Battles, he joined us last hour, the CEO of Clean Harbor, saying that the pipeline there looks very, very strong. Another big theme coming out of this, we just heard that from Joe Ritchie, as well as technology investments, specifically AI. RXO, we know that that's a top priority for them. We also heard it from Johnson Controls talking about the opportunity within that space. They are going to be exploring AI investment even further. We also heard from the Southwest CFO, and she once again reiterated their technology investment, what they're doing in order to upgrade their systems. They expect their network to show significant improvement by the end of the year. But circling back to what we've all been saying about the economy, right? It always comes down to the consumer. And we did get a look at the consumer from Southwest today and really reiterating what we heard in the latest earnings report. And that's the fact that travel demand remains strong. Most of that being driven, or a lot of that, I should say, being driven by the leisure passenger. And she doesn't expect that to change anytime soon. There was a little bit of talk about the debt ceiling. I was bringing it up in a lot of the conversations I was having, just in terms of how CEOs were looking at this issue. Yes, it's something that they are monitoring, but it almost seemed like something that they were shrugging off, at least for now, very similar to the behavior that we have seen from the markets, Diane.
Interesting stuff there, Shauna Smith. No surprise that AI is top of mind in just about every industry. Thank you so much for that wonderful insight from our Shauna Smith. All right, coming up, we check in on the latest market trends with Maconomics, Ross Mac. Stay with us. Welcome back. Inflation is top of mind today with the latest CPI data easing to 4.9%. That's on an annual basis. So what does this mean for the average American? Joining us now to help demystify some of this financial terminology for retail investors is Ross Mack of Mackonomics, who is helping to close the gap between Wall Street and Main Street. So Ross, thank you so much for joining us. I know you've been on the program before. So let's start out with this. When you have a day like today, some fresh econ data coming out that is very much consumer focused data, what is your top takeaway from this?
I think the top takeaway, well, one, thanks for having me. I think the top takeaway you have to say is, okay, we're trending in the right direction. That being that inflation is starting to tick down, right? We've seen this over the past maybe 10 months or so, right? But I think we have to also understand what the Fed has been doing, right? Jerome Powell has been very straightforward with what he's saying, right? We are a long ways away from our 2% target. And so what does that mean, right? I think there's still uncertainty left out there, which might mean, is the Fed going to continue to raise rates? Is there going to be a deal done when it comes to debt ceiling? I think at the end of the day, I think what we understand is that prices are starting to come down, but we still are a lot ways away, right? So I think they just have to say, what impact is that going to have on the markets?
Ross, I want to pick up on what our Shauna Smith was saying when she was speaking with some executives over at the Goldman Sachs conference, because there does seem to be a real divide between what appears to be some caution, but maybe even a little more optimism on Wall Street versus what we're hearing on Main Street. What do you make of that divide? I mean, what are you hearing if it is about Main Street and where consumers are right now?
Well, so when you take a step back and you were at the Goldman conference, if you even go back this past weekend and you see what Warren Buffett and Charlie Munger were saying, at the end of the day, we have to understand there's a lot of different moving parts, right? We look at the overall inventory glut. We see that rates are constantly going higher. What are companies doing in order to continue to cut costs? Is the labor market still too strong? Does that mean the Fed is going to have to raise rates to kind of counteract that? Or are companies saying to themselves, okay, if there is going to be a slowdown in the economy, how are we going to continue to find ways to cut costs? Does that mean we lay off people, right? Especially when it comes to the inventory glut, when so many companies, due to different supply chain disruptions, were saying, let us over order in order to be ready. And now they're seeing consumers not willing to spend as much or not shopping as much, right? And as a result, a lot of companies are now lowering the prices, right, are starting to put out sales. So at the end of the day, what we're starting to see, right, with earnings, we got some mixed earnings, but we are starting to see a little commonality when it comes to forward forecasts. And a lot of companies are expecting to see some slowdown. And so when we talk about, Main Street, I think that some of the things that we have seen is credit card debt is among all-time highs, right? And so at what point do consumers stop spending and businesses try to find other ways to counteract that? Will that lead to more people being fired? Or, so we're seeing, certain jobs laying off people, but the overall economy, we're still seeing a lot of strength. So do we have more room to go?
Yeah. So Ross, yes, to your point, I mean, the recent jobs report came in stronger than expected. So it shows that there are jobs out there, although some people would disagree with that. People who are, being laid off right now. We have company after company announcing layoffs, whether it's the tech sector. Now we're seeing some job cuts in media and entertainment. So what is your audience is looking to you often for advice, for personal finance advice, and you come from a Wall Street background. What's your advice in terms of preparing for a downturn? Because we have talked about the potential for a recession this year. What's the advice? What's the top 3 tips that you give your audience?
I think that's a great question. I think if you asked any economist towards the end of last year, everyone was saying a recession next year. Everyone was saying S&P is going to be flat to down year to date. And as you look this year, right, the market is up, right? But what I will say that in the event there is a recession, right, I don't think your overall strategies when it comes to investing in dollar cost averaging should ever change, right? And that is when you really want to remain disciplined and be a consistent investor. Because I think what happens is when people start listening to the headlines, there's a lot of people, one of the greatest quotes from Warren Buffett is, be greedy when others are fearful and be fearful when others are greedy. And that's one of the reasons why the market is higher, right? But I think that as you continue to take a step back and say, okay, it's impossible for the average investor, even the professionals, to time the market. So how should I think about investing? And I think the number one thing to do is remain disciplined and consistent and continue to dollar cost averaging by investing on a monthly basis. And outside of that, I think that when people start analyzing their own personal expenditures, right, inflows and outflows, I think it is prudent to literally be finding ways to cut costs. That way that you could actually build up a cash reserve in the event there is a recession, which historically will tell you that is the single best time to actually invest. And so remaining disciplined and also having some cash stockpiles so that you could take advantage of in the event there's any dislocation in the market.
Yeah, I'd imagine a lot of people taking a second look at their expenses right now. Ross, thanks so much for that. Ross Mack, creator of Revolt Economics. Well, coming up, we talk to the CFO of Duolingo following the company's latest earnings results. Stick around. Well, Duolingo shares ended the day roughly 10% higher after reporting Q1 earnings that beat analyst estimates. The mobile learning platform reported a 62% annual increase in daily active users. Here to tell us more about the results, we've got Duolingo's Chief Financial Officer, Matt Skaruppa. Matt, it's good to talk to you today. Congratulations on what was a pretty impressive quarter here. The most profitable quarter you've had. We talked about the 62% jump on DAUs. MAUs were up 47%. What's driving the growth?
Well, thanks a lot for having me. And it was a fantastic quarter for us. Probably our best quarter ever, certainly since we've gone public. And what's driving the growth starts with user growth, as you mentioned. We were up 62% year over year, and we've had several quarters of really strong user growth. And that's because we've been making our product more fun and engaging over time. For us, user growth is a leading indicator of basically all the other financial metrics that you mentioned. When users come and use our product every day, we have more chances to show them product improvements and make it so that they're more likely to convert to subscribers, which helps other financial metrics over time.
Okay, so Matt, I want to ask you this, Diane here, about how much AI or generative AI factors into your business.
Yeah, no, it's a great question. We've been using AI for a long time, and that's basically because our co-founder and CEO, Luis von Ahn, is an AI expert. He actually wrote his PhD thesis on how humans can use technology to solve tough problems, and that's led him down the path of Duolingo. So he's been very focused on this, and we've integrated AI into our business for a really long time. It's in fact, when you use our product, artificial intelligence is helping us serve up the right question to you at the right time to make sure you have fun with our product and learn. So we've been using artificial intelligence for a while. The new generative AI theme that's come up recently is also something we were pretty early to. We launched a new product feature, a new tier called Duolingo Max when GPT-4 came out in March. And so we're excited about AI. We think it's a great opportunity for us to make our product more fun and engaging.
Yeah, I mean, I guess the question is, to what extent consumers are there as well. I know this is a higher subscription tier. What's been the uptake there, and how big of a driver do you anticipate this kind of integration is likely to be for you? Are consumers wanting to have more of that real conversation, quote unquote?
Yeah, no, it's a great question. That's why AI for us is a really integrated experience. So for a long time, users have told us that they wanted to interact with our product. And what AI does is it's a really quick, or the generative AI is a really quick response mechanism. So we're able to integrate much more tutor-like conversational response times into our product. So it's a really natural fit for us. And it's something that in our early testing of this new tier, we do see demand for. So we're excited about it. How big it can go, we're not sure yet. I mean, it's early days. So we're going to keep testing and rolling it out over the course of the rest of the year, but we're very excited about it.
Matt, how are you all preparing yourself for any the economic headwinds that may be in front of us? And let's say there's a recession that happens this year. Some speculate that could happen. People would probably cut some subscriptions. How are you all preparing for that?
Yeah, so our experience is that people want to use our product for a lot of reasons. There's two big buckets. There's a bucket of folks who are using it because they want to learn, for example, English, and they want to, better their lives economically. And then there's another bucket of folks who are using it for fun and for meaning and for those reasons. And as we think about the future, and there is uncertainty out there, we think that both of those users are going to continue to use our product. And in the past, what we've seen is through various kind of macro settings. So for us, if you think about before COVID, during COVID, if you think about times of high inflation or low inflation, people have wanted to use our product. So we feel pretty good that we'll be able to go through any headwinds that come. And certainly earlier in this year, all the trends seem to be going in the right direction, which is why we raised our guidance and for the full year and feel good about that.
And Matt, most of us are familiar with Duolingo through learning languages, but you have obviously expanded beyond that, math being a big part of it too. When you think about the uptake there and where you want to take the business in the future, how much of the pie is going to make up that educational component?
Sure. Well, we're a really mission-driven company. Luis and Severin, our co-founders, started it. And our mission is to create the best education in the world and make it universally available. Our mission doesn't say just language learning. So, we're pretty excited about the ability to expand and teach other things. We have a literacy product. We have a math product. We're considering other products like music in the future. So we think that we can expand beyond language learning over time. But in the next several years, for sure, the primary growth engine, both from users and from revenue and bookings, is going to continue to be our language learning product. There's a lot of room to run there. We're pretty early on in monetizing and growing that business.
All right, Matt Skarupa, CFO of Duolingo. Our thanks to you, or should I say gracias. Coming up, we take a deeper dive into Disney's earnings following its latest quarterly report. We're looking at shares under a little bit of pressure after the bell. Stay with us. Disney out with its quarterly report card after the bell. The stock under some pressure after the company reported a miss on second quarter earnings. And revenue, though, was in line with estimates. Joining us now to discuss, along with a broader look at the entertainment and streaming industry, is Third Bridge Group sector analyst Jamie Lumley. Let's get right into it. Jamie, what did you take away from today's earnings from Disney?
Thanks so much for having me today. I think there are a number of things to look at as we start to really read through Disney's earnings from today. First off is looking at subscriber growth. We've already heard not promises, but a change in focus at Disney from looking at the subscriber numbers to really starting to rein in costs, but at the same time, seeing overall subscribers drop across Disney Plus internationally is really one of the big things to look at here. However, on the flip side of that, there is a fact that those losses are starting to be reined in. And this is one of the things that we hear very frequently from our experts is just how much of a priority it is for Bob Iger to really trim those costs. And seeing them, pared down by another couple $100 million, that is moving in the right direction. That being said, there's still a ways to go. And as if we look across this industry, Warner Brothers Discovery reported last week, starting to see some profits in their streaming business. It just starts to really dial up the pressure to understand, okay, when is streaming going to be profitable and when is Disney going to be able to round that corner? One last area definitely worth highlighting, looking at the parks. Growth continues to rebound there, seeing double digits growth based off of or compared with the year ago quarter. So definitely some areas to be encouraged for Disney right now.
Disney is in the midst of a reorganization. Three-pronged is how the company has described it, talking specifically about entertainment, ESPN, Disney parks, and entertainment. If you look at the numbers today, and I realize this was just announced a few months ago, to what extent is Bob Iger steering in the right direction? In other words, are we likely to see any additional shakeups and potential cuts?
It's definitely a good question. And I think we should look back at the goals which Iger outlined during the last call, looking at $5.5 billion of overall cost reductions. $3 billion of that is through content, but then there's, of course, that other part which does come along the lines of restructuring the company, seeing what the right staffing levels are, and really trying to get things up and running for a couple of their businesses, which are loss leaders, mainly streaming right there. Certainly, we're not that far along when it comes to the amount of time which has passed since those changes are being made. But depending on really just how long that timeline is, that is one of those big things, which I'm sure Iger is thinking about very frequently as he proceeds with this year running the company. One of the things we definitely hear from our experts is that Disney is in a period of transition. And as it looks to round the bend for streaming losses and drive growth across all the different businesses, I'm sure they're definitely feeling some pressure when it comes to really seeing delivery of results and paring those losses. So are there going to be more restructures to come? I'm sure that there are a lot of people would hope not, but at the same time, cutting those costs down is a top priority, and Iger will definitely be finding the right way to go about that.
Specifically on streaming, to what extent does the current writer's strike complicate the direction Disney's trying to take things in? We've already heard about production shutdowns on Marvel's Blade. There's also the latest Star Wars series that's been shut down. We still don't know how long this is going to take. What does it mean for the content side of the business?
It's a fair point. And one of the things that I think we've seen is that, of course, the first thing which is impacted immediately are those news shows, those shows which come out on a weekly basis. And then longer term, this is more going to affect the content slated for years to come. So right now, when it comes to Disney's content priorities, while they have had to press pause on a couple of projects, this will not be impacting their content releases in the coming months. This is more of something which will probably be a 2024 impact, especially if the writer's strike is prolonged. We can already see, based off of highlighting again Warner Brothers Discovery, that for them, this is more for some of their immediate shows, not necessarily releases down the road. Disney is probably thinking about this in a similar way of the longer this goes on, the more those challenges will mount. But at the same time, depending on the timeline this is resolved, it could have less of an impact for the out part of this year.
Jamie, one of the things I'm seeing coming out of the earnings, note saying that Disney going to be combining Hulu and Disney Plus into one streaming app. So what does that say to you about where Disney stands with regard to its investment in Hulu?
That's a very interesting point. So there are a couple things to pull out here. First is just looking overall at Disney's strategy. We've been hearing for a long time from our experts that it really has been challenging having Disney Plus and Hulu be separate, just from a branding perspective, from a marketing perspective. There are definitely some challenges to having multiple platforms with different focal points, different audiences that it's trying to reach, whereas if there's one collective platform, it makes a number of things easier. And particularly for Disney, as it's looking to trim its streaming losses, having everything under one banner will make things easier. At the same time, if we look towards the deadline that Disney is facing next year to exercise its option to buy Hulu outright from Comcast, things are still a little bit complicated there. Certainly, if we look and see that these are coming under one platform, then that could be a sign that things may be shifting when it comes to Disney's leadership's priorities. But at the same time, they are cost conscious, and Hulu has been a successful platform. It'll be a multi-billion dollar buying opportunity next year if it is looking to make that acquisition. It's a very large price tag. So those are a couple of factors which I'm sure for the rest of this year will continue to be top of mind for Disney.
And we'll be listening for any additional hints on the future of streaming for Disney in that earnings call. Jamie Lumley, Third Bridge Group sector analyst. Good to talk to you today. Well, Ford is debuting a new Ranger pickup as it looks to keep up with competition in the mid-size pickup space. The Yahoo Finance's Pras Subramanian here with the details for us. Pras.
Hey, Kiko. Yeah, so the mid-size pickup space is hugely competitive, like you mentioned there, dominated by the Toyota Tacoma and also the Chevy Colorado. So Ford took the chance now to actually update that Ranger that actually has seen sales slowing down recently. So they updated the design, also the capability with new engines, but also most importantly, the interior, the cabin fit and finish, and also a large touchscreen, dual touchscreens here. This is what users and buyers are are more accustomed to in these newer trucks, and Ford needs to update that. So this is a big deal for them because, like I said, that new Chevy Colorado just came out, and the new Tacoma is going to come out later this month. That's the #1 seller here in the U.S.
Pras, Diane here. I know you're also taking a closer look at how automakers are looking to subscriptions to generate revenue. Tell us how that's supposed to work.
Yeah, you know how your car basically now is the phone, or the phone is the car, right? So as automakers can add technology on the fly through things they call features on demand or car subscription services, we're seeing more and more of these software and even hardware type upgrades coming to cars with a subscription type model. A lot of people aren't happy about this. The automakers know they can make money this way, but a new study from Cox finds that 3/4 of people find that they think that these are just money-making schemes by the automakers. And 69% say that if an automaker does this, they don't want to buy the car. They'll look at another brand. So this is kind of a big deal for companies that need to sort of increase their bottom line, but also add new features that you can do with these cars. BMW famously about a year ago tried to have people pay for heated seats. This functionality is already in the car itself, but in order to turn it on, if you didn't buy it from the factory, they wanted you to pay a subscription. So they did that abroad. People heard about it here, very upsetting about that. Mercedes just added the ability to add acceleration boosts to its EVs via subscription. And then Toyota did the same thing with their connected features on their phone. If you want to unlock the car or do things like that, you have to pay an extra fee by month to do these connected features on your phone. So a lot of kind of consternation there by buyers. Automakers kind of binder because they want to increase profits that way. So that's sort of where we are in this landscape where features on demand are a thing that's going to stay.
Yeah, and they make it so easy to just add those features, right? Because you just tap the screen and go. By the way, Pras, can I just say, this is my biggest fear when it comes to driving, that my phone is going to shut down one day and I will not be able to open my car. I don't think I'm the only one.
Yeah, people have had that issue, actually. It's like, you got to have like an actual card that you have in your wallet that you can use to open your car. But yeah, that is a problem. When the phone or the key is the phone, that's going to be a problem.
Yep. All right, Pras Subramanian, as always, thanks so much for that. Well, it is closing time here at Yahoo Finance. Let's get you caught up on the biggest stories of the day. First up, Disney reporting mixed second quarter results. On the plus side, the park side of the business remains strong and streaming losses narrowed by more than expected. But Disney Plus subscribers came in lighter than estimated.
Meantime, let's talk inflation. In April, headline inflation rose 0.4% over the prior month. And 4.9% over the prior year. The core measure, which strips out some of the more volatile prices like food and fuel, rose 0.4% over the prior month and 5.5% over last year. Now, those numbers are still well above the Fed's 2% target rate.
And then Google making some waves at its annual I/O Developers Conference. On the AI front, the company is dropping the wait list to use its generative AI Bard. It's also incorporating generative AI into search. When it comes to hardware, Google announced its $499 Pixel tablet, which will start shipping in June. We also learned more about the Pixel Fold, its foldable smartphone. It's going to sell for $1799 and start shipping in late June. That's a price.
That is
price tag,
pricey indeed. All right, we're going to have to leave it there. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.